Hello, I'm Kathy Carey, Director of Research for Baird Private Wealth Management. Although we like to focus on longer-term investing and not on near-term market choppiness, a presidential election in the midst of a pandemic has raised a lot of valid questions from Baird clients. In this week's video update from our market strategy experts at Strategas, Jason Trennert, Strategas CEO, and Dan Clifton, Head of Washington Policy Research, address questions from Baird clients about the economy, the stock market, and the potential policy issues ahead of the November 3rd election.
Hi everyone, I'm Jason Trennert, Chairman of Strategas, a Baird company. Today I wanted to discuss a couple of ideas that are on the minds of investors. The first really has to do with the apparent divergence between some of the weakness we've seen in the economy and the strength that we've seen in the market. We explain that largely as a matter of composition, which is to say, if you remember from your economics textbooks, GDP is made up of consumption plus investment plus government spending plus net exports. Consumption is a little less than 70% of the overall economy. When you look at the S&P 500, 28% of it just in and of itself is technology. Healthcare is another 14, communications is 11, financials are another 10. So you're getting close to more than 60% of the market without even really discussing the consumer part of the economy. Consumer discretionary as a sector is only about 12%. So that's pretty much the biggest difference between the two. The U.S. economy is much more consumer spending oriented. The S&P 500 is more manufacturing oriented. Economy is more domestic. The S&P 500 is more international. Another thing that we've taken a look at and people ask us about is our bull market top checklist. And we like checklists at Strategas quite a bit because it keeps us honest. And we try to make sure that we don't get too focused on our thinking or don't breathe our own oxygen. And we're trying to constantly test what our assumptions are. And so we have a checklist. We have 9 items on the checklist, and mercifully I won't go through them all. But I can tell you right now, only one of the 9 things that we normally look at are giving us some indication that you're close to a big bull market top. That would be IPO activity. Obviously, you want to get nervous when other people are greedy, and their IPO activity is probably showing there is some greed, but there's a lot of other things that on our checklist that don't show that. One of the primary ones is just equity mutual fund flows, and ETF flows have actually been in outflows for the past 11 years. The other thing you could take a look at from a valuation perspective that we think is important are corporate credit spreads and upward earnings revisions. And all of those things corporate credit spreads are quite low, and upward earnings revisions are actually moving higher. So all of those things are good. So in our opinion, you don't have the types of euphoria that are normally associated with a big bull market top. The last thing I wanted to talk about a little bit is a little bit of a risk in the index itself, on the S&P 500, which is that Facebook, Microsoft, Apple, Amazon are about 23% of the market. You have 5 stocks that make up about a quarter of the market capitalization of the S&P 500. That's an issue, I would argue, just to the extent to which people tend to invest in indices to diversify their risk. And it seems to me that right now, if you're investing in the S&P 500, you're taking a lot of risk in just 5 stocks. And so active management, in my opinion, and most of our clients are active managers, so we may be a little bit biased, but it seems to me active management makes more sense when you have this kind of concentration risk in the S&P 500. I'd also say there's a growing political risk among big tech as well. And clearly, obviously, the federal government is talking about antitrust, or is lobbed antitrust suits at some of these companies. We would expect more to come, but there are other issues, clearly social and cultural issues that are facing these companies. Ultimately, they have enough money probably to prevail in court, but I will say, just based on my own experience, whether it's IBM in the 70s or Microsoft in the 90s, you don't, generally speaking, want to be in the crosshairs of the federal government. Nothing good really happens from that. Even if you win, you tend to lose because you tend to lose focus on the job at hand. So that is some risk, in my opinion, for the overall market. At any rate, I hope these are some items or some questions that I answered that are helpful to you. If you have any questions, additional questions, or I can provide any other insight, please let me know. Thank you very much.
Hi, I'm Dan Clifton, Head of Policy Research at Strategas Securities. We're just a few days away from the 2020 election, and I thought I would discuss some of the key issues that investors are asking about ahead of the 2020 election. The first question is, are the polls useful? And what other indicators do you look at to determine the election if the polls are not accurate? I would say, in light of the 2016 election and the polling failure that resulted from that, there have been some changes made to the polling industry, particularly trying to identify groups of individuals that may be less likely to participate in surveys and to wait for them. Still, the polling industry is in decline. Many people do not have landlines anymore, and some people are just unwilling to express their opinion about politics. And so what we've done at Strategas is start to look at what I would call non-traditional political indicators and discuss how they are viewing the election just days ahead of the election. The first is the S&P 500. The S&P 500 has predicted every presidential election winner since 1984 and 87% of the presidential election winners since 1928. It's a pretty simple formula. If stocks are higher in the 3-month period leading into the election, the party in power has won. And if stocks are lower in that 3-month period leading into the election, the opposition party has won. That clock started on August 3rd of this year. And for most of the late summer, early spring, early fall, you saw stocks higher over that period. What is interesting is that this week stocks crossed below that even level and are now down since the August 3rd period, usually a sign that the opposition party would win. In this case, it would be Joe Biden. Now, this indicator is not perfect. It's worked 87% of the time. I like anything that works 87% of the time. We're never going to get perfect. But there are also other factors involved in what's driving stocks today. Are we going to do a fiscal policy stimulus? What's happening with the vaccine? What's happening with COVID-19? So this year, there seems to be a number of larger issues than just the election itself. And so we look at other indicators as well. The US dollar has predicted 7 of the past 8 elections. Again, very similar to stocks. If the dollar is lower in the 3-month period before the election, the party in power has usually won. And if the dollar is higher in that 3-month period, the opposition party has won. Interestingly, this week, the dollar has also gone higher, another sign that Joe Biden would win the presidency. I would note with caution, this could change between now and the election, and it could be that these indicators are signaling just that the race is closer than what the polls are anticipating, because both of them are right near the even line itself. A third indicator that we look at is what I call our Trump and our Biden portfolios. We build election portfolios to see how the market is pricing in the election. This worked with great accuracy in 2016 by indicating to us that Trump had a better chance of winning based on the stocks that are levered to a Trump presidency relative to a Clinton presidency. This year, it's been quite the opposite. Our Biden portfolio has outperformed our Trump portfolio, and the implied probability of that performance is about 70%. What's in our Biden portfolio? Renewable energy, infrastructure, companies tied to technology and foreign revenue exposure like semiconductors that will benefit from Biden's trade policy relative to Trump, as well as companies tied to state governments, as we anticipate the Democrats will give more state aid. In our Trump portfolio, we have financials, oil and gas, defense stocks, and what I like to call the for-profits. These are for-profit prisons, for-profit education, student lenders. They're not widely held stocks, but they are stocks that are very good indicators of the election given the binary outcomes that are facing those companies based on the election outcome itself. A fourth indicator that we like to look at is what I call our Strategas economic election model. This takes stocks, the dollar, GDP, and the president's approval rating and puts it all into one formula. That model has usually predicted the incumbent party's share of the two-party vote within 0.2%. And that indicator is telling us that the race will be much closer than the polls suggest, but that Biden is starting to become the favorite here down the stretch. And I think some of that is just that the undecided voters are now breaking away from the incumbent and to the opposition party itself. So those indicators have all been at odds with the polling for most of this election cycle. And it's been interesting as we've gotten into the final week, you've started to see a bit of a convergence. And we will continue to monitor these indicators over the next few days as we go deeper into the election cycle. What is the outlook for fiscal stimulus is the second question that we are getting from clients. Congress obviously put a lot of money into fiscal stimulus as a way to kind of gap the shutdowns that were coming from COVID-19. A lot of that money has been spent, and we've just seen the benefits of that very significant fiscal policy stimulus where the U.S. economy has increased in the third quarter by about 33% growth rate, the largest ever on record, and a sign that the efforts of Congress and the Federal Reserve have worked to stabilize the U.S. economy during this pandemic. The big question from investors is what's it going to look like for the next round of fiscal stimulus, and how does the election play into that? Congress could not reach a deal before the election, and I almost feel as if both parties said, let's have an election and decide who gets what when this is over. In other words, if the Democrats win the White House, regain the Senate, and keep the House of Representatives, you will get a fiscal policy stimulus that will look a lot like what the House of Representatives passed in the month of October. That was about a $2.4 trillion stimulus that was focused on more money for state governments, more money for Medicaid, more money for unemployment insurance, more money for small businesses through the PPP program, as well as a lot of money for COVID-19, such as testing, contact tracing, money for healthcare providers so that they can continue to treat patients with COVID-19, as well as refund checks of about $1,200 per person and $1,000 for each child. So it's a very significant stimulus if the Democrats sweep. There's a question about timing around that stimulus. Do the Democrats come in and do an emergency stimulus in January and then do a larger reform in May or June? That's something that's being talked about. Or do we need something even quicker in the lame duck session of Congress? And I think that will be much more difficult to get if the president loses re-election and if the Republicans lose the Senate. They're basically going to go home and say, Democrats, you're going to be in charge in January. You figure this out. Secondly, if you get a status quo election, that status quo election says Donald Trump wins the presidency, Republicans keep the Senate, Democrats keep the House. I'm actually fairly optimistic that we can reach an agreement before the holiday season in December. I want to be clear, it won't be very easy to get that resolution, and it will be a hard-fought fight. But if you go back to 2012 when President Obama ran for re-election, everybody who was in office stayed in office. The president won re-election, the Democrats kept the Senate, and the Republicans kept the House. Almost the reverse of what a status quo election would be here today between the two parties. And what I mean by that is that we had about 1/3 of the U.S. tax code expiring on December 31st. And really the election, by having a status quo election, allowed both parties to get in a room and figure out what that deal was going to be before we saw significant tax increases and spending cuts go into effect. Of course, they did this at like 11:58 at night on New Year's Eve, right before the January 1st deadline. And it was a hard-fought 6 or 7 weeks of them doing that. but it ultimately got done. If you get a different situation where Joe Biden wins the presidency and the Republicans keep the Senate, I think it will be harder to find some sort of resolution in the 2 months following the election, and it will likely get kicked out to January. But I want to be clear on the fiscal policy stimulus front is that given that about 1/3 of the money is used for COVID-19 and we're seeing COVID-19 cases increasing, and that there is still a need for additional fiscal stimulus before a vaccine comes online in 2021, my anticipation is that you are going to get additional fiscal stimulus. It's just a question of how much and what will be included in that, and that's what the election will determine. The third question that we are getting from clients is about tax increases around the 2021 election. I want to be clear, if President Trump wins re-election, you're likely going to get tax cuts in 2021. If Joe Biden wins the presidency and the Republicans keep the Senate, you're likely going to see neither tax increases nor tax cuts. And then third, if the Democrats sweep, with Joe Biden winning the presidency and the Democrats taking the Senate, it is very likely that we will see tax increases enacted at some point in 2021. These will be tax increases targeted to the upper end of the income spectrum, tax increases on the top marginal income tax rate, tax increases on capital gains, dividends, and the estate tax. The estate tax is very interesting. Joe Biden just put out a new proposal where he will raise the estate tax rate, he will lower the estate tax exemption, he will change the basis by which heirs can receive that property to a carryover basis, and then imposes an unrealized capital gain when that property is transferred to the heirs. Now, I don't really believe something like that can get enacted, but that is as wide-ranging of a proposal that we've seen, and it shows you that the Democrats are very focused on taxing wealth to address income inequality. There's also likely going to be a corporate tax rate increase. Now, one thing that the Biden campaign have been saying is that that tax increase may not go into effect until 2022, and it may be phased in over time. It's very important for S&P 500 earnings because if you delay that tax increase by a year, you're likely going to save about 10% on an earnings per share basis. But overall, our experience is that all else being equal, higher taxes on capital gains usually leads to a surge of merger activity before the tax increase and before dividend tax increase, a surge of special dividends paid out. But once that tax increase goes into effect, you've lowered the after-tax rate of return on investment. It slows down future capital gains realizations. The tax increase on the upper income usually does crimp some consumption. About the top 20% of income earners are responsible for 40% of U.S. consumption. Some of that tax increase will be offset by a reinstatement of the state and local tax deduction, but it won't be fully offset itself. So those are the answers to the three big questions that we're getting from clients as we go into the final days here of the 2020 election. Please let us know if we can be of assistance, and thank you for listening today.